Transformation in the recent year in the money market in India. So what important changes have taken place in the money market in India? Money market has been undergoing rapid transformation in the recent year in the wake of deregulation process. Now, what is deregulation process? Initiated by Government of India or RBI. That means interest rate is deregulated. Deregulated. Now you have to again tell me what is interest rate is deregulated means. Demand and supply for money. Deregulated does not mean they will not monitor the money market. In fact, they are monitoring more. But they are given freedom to decide what is the interest rate. Demand and supply forces influence interest rate. Earlier, RBI used to give a dictate, you will charge so much interest. Okay. But those days are over now. Let the market decide. So this can be one common point in many answers. How is interest rate determined in a money market instrument? So for most of the instrument, the interest rate is not determined by demand and supply forces. It is left to the market forces. So when you are raising funds at that point of time, what is the situation in the market? Accordingly, the interest rate will be decided. So that is the deregulation. Let the market decide. Institutions of primary dealers and satellite dealers have been set up as specialized institutions to facilitate active secondary market for money market instrument. So the next is they are trying to develop the secondary market for money market instrument. In India, secondary market for money market instrument is very weak. It is not as big or as efficient as capital market. For capital market, you have stock exchanges. But for money market instrument, secondary market is not well developed. So they are developing the institutions of primary dealer, and below primary dealer there is called satellite dealer. That means through them you can buy and sell. Once IPO is over, then if you want to buy or sell, you can buy or sell through these PDs and SDs, primary dealers and satellite dealer. So you want to know what is primary dealer. So that I have written in the bracket in blue color. So if you want, you can write. Primary dealers can be referred to as merchant bankers to Government of India. Merchant bankers to Government of India. Merchant bankers to Government of India, comprising the first tier of the government securities market. Comprising the first tier of the government securities market. Okay. So this is basically they are buying and selling government securities. And below them, there are satellite dealers. Who are satellite dealers? Satellite dealers work in tandem with the primary dealers. Work in tandem means close cooperation with the primary dealers, forming the second tier of the market. To cater to the retail requirement of the market. Forming the second tier of the market to cater to the retail requirement of the market. So you can say primary dealers are the main ones. They are like big wholesalers, and below them are satellite dealers. And if you want to buy or sell government security in secondary market, you can deal through PDs and SDs. But you don't worry, only this much information is enough. These are usually large merchant banking houses who act as a primary dealer and secondary dealer. So government is trying to develop this market so that activity in the secondary market will also increase. What is the next transformation? New money market instruments have been introduced and more institutions have been permitted as players in the market. So lot of new institutions are allowed to buy and sell money market instruments which were earlier banned for them. Is it right? We'll discuss them in some separate paragraph, which are these institutions. Interest rate in respect of, this is one major change, have been completely freed. You have written a note also, and are allowed to be fixed in terms of market forces of demand and supply. So these are some important changes in the money market in the last few years. This question was asked in the old SFM syllabus. What are the rigidities in the Indian money market? Old SFM syllabus. This chapter money market was in the old SFM syllabus. Now they have removed in the new SFM syllabus and they have made it a part of capital market subject. Okay. Rigidities means, you can say drawbacks. You write there drawbacks. Lacuna, problems, hindrances, shortcomings, something which is preventing the Indian money market to grow to the desired extent. Why Indian money market is not as efficient and successful as some countries like US? That is my question. And this question you have to keep in mind, and the answer also they have given in detail. In old SFM book it was just 4 or 5 lines. Now they have made it one full page only. Notwithstanding, this is one word, notwithstanding, the regulation process initiated by the RBI and several innovations. That means RBI is trying its best. They are allowing a lot of freedom to the participant. The money market is not still free from certain rigidities, which is hampering the growth of the market. So this question you mark important because they have already asked in some other exam of CA course. What do paper setters do? They first see whether there is any past history. They will take past exam question RTQ on same topic. Then paste. Who will apply your own mind when ready-made things are available? So therefore past exam questions are important. So one is market is not integrated. We had seen in one of the prerequisites of an efficient money market, market should be integrated. Money should flow from one market to other. Interest rate should be aligned. Okay. There should be a well-developed secondary market also. So we will find there is a secondary market for capital market instrument which does not exist for money market instrument. Underline, I think this word is missing in your notes. So you have to add, there is a well-developed secondary capital market, or there is a well-developed secondary market for capital instrument in India which does not exist for money market instruments. Like if I ask you go and purchase commercial paper for me, you will wonder where should I go, which market I should go, which party I should contact. Even I don't know. Maybe you have to go to Bombay and get in touch with some primary dealers. Okay. Then they will ask, do you have 25 lakh rupees with you? You will say, no, I am a poor article. I don't have 25 lakh. Players are restricted. Limited players means again prices may not be efficiently determined. Liquidity will not be sufficient. Okay. So who are the players right now? Government, because it needs money. Banks, they have to maintain SLR. FIIs, they get more interest in India compared to USA. and big corporates because they have to park their short-term surplus or raise funds. So they are the main players. Retail investors like you or me are rarely interested in the money market instrument. So I don't think you may have ever purchased treasury bill, commercial paper, certificate of deposit. Even I have also not. At the most I invest in the bank FD and the bank invest wherever they want, that is their index. Or I invest in mutual fund and they invest in these instruments. Okay. But directly we are not participating. It is restricted only to corporate, government, FIIs. Third rigidity, supply-based sources influence the usage. That is, the person who is supplying the funds is dominating the market in deciding where the money should go. Who are the main supplier of funds? Banks. And then bank decide to whom they should lend. That is the meaning of this heading. Supply-based sources influence the usage. So banks are the main sources. Commercial banks are the main supplier of funds in money market instruments, especially RBI, which issues treasury bill on behalf of the government. And then one rigidity which is coming again and again right now is you don't have too many different varieties of instrument available for trading or purchasing. Unlike European market has many varieties. Only few money market instruments are available, like treasury bill, commercial paper, commercial bill also, that bill of exchange market is not that developed. Certificate of deposit is there and interbank call money, notice money is there. These are the instruments. Many of you may have heard this name also for the first time. Yes or no? Like for example, it's possible you may not have heard something like call or notice money or commercial bill or certificate of deposit. Now next problem is for banks. They are forced by the RBI to maintain their CRR and SLR. CRR is maintained with whom? RBI. Cash balance kept with RBI on which you don't get any interest also. So that much funds have been blocked which could have otherwise been invested in some money market avenue. SLR is again an enforced obligation on the bank that you have to keep so much funds in liquid assets. One of the reasons they are putting this SLR requirement is that this will force the bank to purchase the government securities. It's like a forced government security sell to them through SLR requirement. But that much money then cannot move to other money market instruments. Lack of transparency. Because of lack of a well-developed secondary market also. We don't know much about the money market instrument. Do you know? About share market, you know a lot of things. Because every day the news comes about share market activities. But do you have a lot of news coming up, at least in the prime media front page, about money market instrument? Do you hear in the newspaper, treasury bill was issued by the RBI? No, never. It comes in some inside pages in some remote corner which you normally don't bother. In general, I sometimes read, most of the transactions are OTC, over the counter. Buyer and seller will meet with each other physically or on the phone and they decide the terms and conditions. So there's a lack of transparency and public information. So we don't know what is happening. Commercial transactions are mainly in cash. Now, cash here does not mean currency note. Of course, because RBI will not allow you to use physical cash. Since most of the transactions are done through cash, the circulation of funds in money market instrument is restricted. So people directly borrow or lend from the bank. And therefore activity in money market is limited. If I have to borrow money, I will take a cash credit from the bank, overdraft from the bank, term loan from the bank, but I will not issue commercial paper or similar money market instrument. So that is, you can say, my interpretation of this paragraph, that directly you borrow or lend from the bank, which means other money market instruments are not being used much. Next rigidity, which is very serious, heavy stamp duty, limiting use of exchange bills. The bill of exchange is not used much because stamp duty is paid, to be paid, and therefore in India we are very cost conscious country. We will not pay stamp duty, and if you don't pay stamp duty, you can't issue that instrument, use that instrument. In case of commercial paper also, at present in India, there is a stamp duty rate applicable to non-bank entities, underline, which is 5 times more than those applicable to banks. Stamp duty rate is high on commercial paper. In one question, we are going to use that stamp duty figure also in solving the answer. After some time, I have a question on this point. And moreover, a CP attracts a stamp duty for 90 days, irrespective of the tenure. Whether you want to issue for 1 month, 3 months or 6 months, they will charge you a stamp duty for 90 days. Which means if you want to raise funds only for say 30 days, still you will have to pay stamp duty for say 90 days, whatever is that calculation. CPs issued for shorter period attracts higher stamp duty, making it an expensive financial instrument. Even though in one of the benefits of commercial paper, you will read after some 1 or 2 pages that it is a cheaper source of finance, but practically it is not cheap. Even though interest rate is lower, but then there are other costs that you incur, like you have seen just now, stamp duty, which is to be borne only by the company. You can't recover it from the or adjust it against the payment to the investor. You have to bear it. Then you have to incur other related expenses also. One question which they have asked in old syllabus of SFM at least 10 times, is the difference between capital market and money market. So what I have done, 11 points I have identified, and then I have made a summary of that, so that you can write anything they ask. This much is enough for 5-6 mark question. So I'll read from your book, I think on the screen it is not appearing. First point of difference is, it is a market for lending and borrowing of short-term funds up to 1 year. Capital market deals in long-term securities, that is for a period beyond 1 year. Very easy. We start with the basic difference and then you go to more and more difficult differences. Second point is, it is not a well-defined market where business is done. There is no specific place or region or area, location where it is done. It is again over the counter, on the phone. But in case of capital market, there is a well-defined market where business is done, and that is called stock exchange. 3. It deals in short-term financial asset. Example, interbank call money, treasury bill, commercial paper. Capital market deals in medium and long-term financial asset. For example, equity share, preference share, you can add preference share also, debenture, bonds, debentures के बाद you can add bonds. Point 4, there is no subdivision in the money market. Subdivision means there is no category like primary or secondary market, but then I have written one note there. Slowly a secondary market in greater form is coming up in the money market also, which we saw just now. Government is developing primary dealers and satellite dealers. So maybe this drawback will be removed over a period of time. There is a classification between primary market and secondary market. Point 5. The total value of transaction in money market far exceeds the capital market. That must be a surprise news for you. but because the players are big, one transaction is very big, so the volume is very high, value is very high. In terms of number of transaction it may be less, but in terms of rupees value of those transaction it is very high. Capital market lag behind the total value of transactions in the money market. This all will be required for true and false also. Capital market lag behind money market in total value. You will say no, capital market is very big. You will write true, but actually it is. If this sentence comes, then it is a true statement, but otherwise if they ask you, false. Number of instruments dealt in money markets are vary. Now, as compared to capital market, we have more variety of instrument like interbank call money, notice money up to 14 days, short-term deposits up to 3 months, 91-day treasury bill, 182 days treasury bill, commercial paper. You add one more, certificate of deposit. Certificate of deposit. Then you also add intercorporate deposit. Intercorporate deposit, ICD. Intercorporate deposit. And then on the right side, number of instruments in capital market are shares and debentures. 7. Participants in money market are bankers, RBI, government. You also add there mutual funds, corporates, mutual funds, corporates, FII, and come to right side. 3 items you have added. Insurance companies also you add. Mutual fund, insurance company, corporates, FII. Capital market participants in capital markets are general investors, brokers, merchant banker, registrar to issue, underwriters, corporate investor, FIIs, bankers. So you can understand, you can say retail investors are usually not there in the money market transactions. Okay. Point 8. Regulated by RBI. Most of the instruments are regulated by RBI. And capital market, most of the instruments are regulated by SEBI. In fact, there is a war between RBI and SEBI also that many people don't know. Why do the RBI and SEBI fight? Because they say this instrument is issued by a company, commercial paper, for example. This is a listed company. So SEBI says, I should have jurisdiction over this instrument. This is my territory. RBI says, no, this is for less than 1 year. We are money market regulator, so this is my territory. Okay. So sometimes there is a war between this RBI and SEBI, but we don't bother right now. Yes, in India people want to have more and more control. And that is why this commercial paper sometimes is a fight between RBI and SEBI. Earlier it was in news also, but it was some time back. Similarly, when some new instrument is designed by corporate, again these two entities fight that who will control it. Point number 9, money market risk is less. Risk is less. Why? Because most of them are debt security, government security, and I have written reason. Maturity of 1 year or less gives little time for a default to occur. So the risk is minimized. But there are some corporates who have defaulted in repayment of commercial paper. Okay. So risk is there, but it is relatively very low. You can't say no risk. Because in the recent newspapers you have read, or you might have read earlier, that some companies have defaulted in commercial papers. I will not take the names, not good. Risk is more and varied. In capital market, risk is more because you have to invest in equity share. Risk varies both in degree and nature throughout the capital market. Degree of risk is more in equity share. Degree of risk of default is there in case of debt instruments. So nature means How the risk can occur? Default. Risk degree means the quantum of risk. Equity share you can lose 80 to 90%, 100% of the value. If not 100%, close to 100% of the value of your investment. That is the degree. And nature. Risk of default is there. Point number 10. Who regulates rate of interest in money market? Rate of interest in money market is controlled by RBI or central bank of any country. That means they will decide what has to be done, even if it is market forces, but RBI will give that instruction. So from where the instruction comes about rate of interest? RBI. And RBI does have a role in money interest rate, because the moment they increase repo rate, other interest rates also get affected. But capital markets interest and dividend rate depends on demand and supply of security and stock market Sensex conditions. So there it is totally different parameters which influence the interest and dividend. Then point number 11, relationship with central bank. Money market is closely and directly linked with the central bank of the country. Capital market feels central bank's influence, but mainly indirectly. There is no direct interference of central bank, but indirectly. Because if interest rate is high in the money market instrument, then probably people will switch from share market to money market instrument. If interest rate is low, people will borrow money to invest in the share market. So it does not mean interest rate or money market does not influence the share market, but not directly, indirectly. Is it right? So this is really important paragraph. Questions can be multiple choice question, true false question, fill in the blanks question, and direct question like the way it is appearing, distinction between money market and capital market. So this is open book exam, so you can just write down these 11 points. I have tried to summarize almost all points given in the material in the form of a table. Okay. Now next is, who are the participants? So first we'll have a broad category of participant. We'll divide the participants into two segments. Organized, unorganized. Organized means they are regulated by RBI, Companies Act. They come under some or the other regulating agency. They are subject to regulation. They have to follow some regulation guideline, etc. Like banks, okay, mutual funds, corporates. Unorganized means they do not come under regulation. They are not properly regulated. They are outside the jurisdiction of RBI. Paragraph next. Who are the principal intermediaries in the organized segment? Principal, main entities, organized segment. So one is commercial bank and other banks. Other banks means cooperative banks or any other bank. NBFCs, they are also big players. Cooperative societies, they are the principal intermediaries. What are the primary activities of these principal intermediaries? Intermediary means they are trying to bring two parties together. The one who has surplus and the one who has deficit. Banks itself don't need money. Bank is just an intermediary. Have you ever visualized? Bank does not need money for itself. It needs money so that it can lend money. So that is why it is intermediary. Bank is a financial intermediary. NBFC is a financial intermediary. Cooperative society is a financial intermediary. They bring the person who save and the one who need money together. Now, what are the primary activities of this intermediary? They accept deposit from public, as you know, and lend them on short-term basis to industrial and trading organizations. Okay. So you are a article clerk. Hard earned money. You invest in bank, and then bank will give it to a trading organization, industrialist, farmer. Okay. So what bank is doing here? You have surplus, he has deficit. It is bringing the two together. You will not directly lend to some company, will you? Because you don't know. You don't have so much of time to evaluate the risk, and you don't have time to go for collateral, registration of collateral, and whatever back end formalities are required, you can't do that. But you can simply approach a bank and open an FD account. That much you can do. So that is the benefit of intermediary. Same thing for NBFC also. In recent years, they have extended their activities to rural areas to support agricultural operations. So that is what banks do. There is also an active interbank loan market as part of the organized money market. What is interbank loan market? One bank lending to other bank, usually for short term, so that the one bank which has surplus can earn interest on its surplus, and the one who needs money can borrow from other banks. So what are the main features of organized money market in India? Main features. Many of them we have already seen. Once again, some points might be repeated. A significant part of its operation, which is dominated by commercial bank. So one feature is subject to tight control by RBI. Underline one important feature of money market in India. Most of these entities who are into money market activity, most of them have to strictly follow the boss. But who is the boss here? RBI. For example, which regulates the interest rate structure on deposit as well as loans. Whatever their guidelines are there, you have to follow. So it's not that they will tell you that you have to charge this rate of interest, but they will give you an overall guideline. Okay, like for example, for sectors like agriculture, export, small scale company, they have a guideline that they would usually be charged a lower rate of interest. Then RBI gives them reserve requirement guideline. This is for bank, CRR, SLR. RBI gives them guideline for sectoral allocation of credit. Sectoral allocation means some portion of your loans should be given to priority sector like agriculture, okay, export, small scale industries, SMI, small and medium scale industries, export, agri, rural areas. And then RBI also provides support to the bank by lending them on a short term basis and ensuring the deposits made by the public. So as you have learnt in one previous chapter, RBI also gives short term loan to the banks through that repo mechanism. If you have government security, you sell it to the RBI at 95 and repurchase it at 100 rupees. The difference is the interest you have paid to the RBI. Then those who have deposited in scheduled bank, you must know this, good for you, up to rupees 1 lakh if you have deposited, it is insured by RBI. Suppose that bank is not able to pay that 1 lakh rupees, then what will you do? RBI. But up to 1 lakh. For NBFC, there is no such insurance. For certificate of deposit, that we'll see after some minutes, there is no such insurance. It's only for FDs up to rupees 1 lakh. The idea is to promote the saving habits among the people. One of my friends, what he does, he takes 5 FDs for 5 members in the family, 1 lakh rupees each. This is in case something goes wrong, each of us will be able to get 1 lakh rupees from RBI. What an idea. Good or bad? Good. Whatever is good for you is good. It is characterized by fairly rigid and complex rules. This is another feature. First was it was heavily regulated by RBI, and second there are a lot of rules and regulations which they have to follow, issued by RBI or in general whatever are the rules for corporates, which may prevent it from meeting the needs of some borrowers even though funds may be available. Okay, because lot of checking, inspection, audit is done. The party to whom you are lending must meet that repayment obligations requirement, and therefore many times banks are not able to lend, but NBFCs lend, and many times they are not able to recover also and suffer losses. Yeah, they lend at high rate. Another feature of organized money market in India is there is a shortage of loanable funds. There is a paucity, means shortage. They don't have enough money to lend in the money market because the low rate of interest paid on deposit. What is the meaning of low rate of interest paid on deposit? If they give low rate of interest, depositor will not be attracted. In the last many years since mutual funds have started, people have started understanding stock market or other investment avenues. More and more people are investing in those other investment avenues, especially like mutual fund or share market. Okay, which means they are not investing in bank FD. If the banks don't raise money through FDs, bank will not be able to lend money also. So that is why you will see banks are very aggressive in marketing their FDs. Have you seen them marketing their FDs? No. Suppose you go to some park in the morning sometime. Okay, once I had gone, Kamala Nehru Park. Then there were a lot of people in that on that day, about 20-30 people of a particular bank, and they were carrying a small pamphlet, and it says interest rate 8.5% on 1 year FD. Nawazuddin Siddiqui was the brand ambassador. Which bank? Jana Bank. Yeah, now I remember. A small family. I was surprised when I thought that I will use it as an example in my class, that they will borrow from you at 8.5%. And imagine at what rate they are going to charge to their borrower, maybe 18, 20, 24%. Okay. But in order to lend money, you should be able to first raise money. Is it right? Even in my office, bank managers come of a particular bank, big bank. And they say, sir, please make FD in our bank. We'll give you 7% interest rate. I said, 7 is very low. Plus you will charge me income tax also, 30%. So what I am left with? Nothing. 4% something. It's better I invest in the share market or mutual fund. Maybe I'll earn more. He says, no, it is very risky. But then I will choose a right security. Why it is risky? So this way, this last line tells me that yes, banks have this shortage of funds now because FDs have come down. Still on a very high side. In India, people still trust bank FDs. The principal participants in unorganized money market. Now quickly, unorganized money market don't spend much time. Money lender, those indigenous banker, okay, that is they will take some collateral from you, give you loan. If you repay, they will return your collateral otherwise. Money lender sometimes lend you without any collateral. He has you know each other. Then there are some small group of people who come together and lend money to each other. Mutual loan associations. But they are very small group of people. Okay. And similar is chit funds. What is cheat fund? Everybody deposit a certain amount every month or periodically, and one of them will take the entire amount. Okay, something like that it works. Again, in the next round, some other party will take the funds. If two or more party wants to take the fund, then they will have to bargain about the interest. Who will be willing to give how much discount? Suppose the kit is 1 lakh and one person is very much in the need of money, he will be willing to take 99,000 only. That 1,000 is willing to leave, and that is like your interest you are paying. And what these people do, they lend primarily to borrowers who are not able to get credit from the organized money market. That is why governments have many schemes nowadays for poor people who can get some kind of loan from the banks. Okay. So there are Grameen banks, microfinance institutions. They will even lend 1,000 rupees, 2,000 rupees so that poor people can get some help. Then what are the characteristics of the unorganized money market? So in the next 4 points, these are the characteristics of unorganized money market. Informal procedure. Do we have to give our Aadhaar card, PAN card, driving license, address proof, and submit a form of 5 pages to take a loan from money lender? No. Then you are going to money lender and say, come Ram Charan, come, sit down, have this tea. Okay, how much you want? 1 lakh. Okay, take. When will you repay? After 3 months. Okay, pay 30% interest. Okay. He says, yes sir. Okay. Go. Next. That is called informal procedure. No documentation, no writing. Sometimes they will take some kind of writing, but that is very ordinary. Not like a proper bank loan documentation. Flexible terms. How much you want, for what period you want, you just sit down, negotiate, done. Attractive rate of interest to depositor. To depositor, they will offer a high rate of interest. But at the same time, they charge even a higher rate of interest to those who borrow from them. And the high rate of interest to borrowers. So first they will offer say 15% to depositor, but they charge 30-40% to the borrower. Okay. But I recommend that you don't fall into such traps. Always go by organized route only. Always should go by organized. There must be proper documentation, and that also creates a pressure on the other party to return your money back. Or at least you can report to the regulating agencies in case of fraud. Okay. But if you invest in unorganized market where people offer very high rate of interest, then you can understand something is wrong. Anything above the normal rate of return means something is wrong, and you have to be careful. Because I have seen a lot of people, close friends, who have lost everything because of this unorganized market. One person said, I'll pay 36% interest rate. 36%, the moment you hear it, oh, it's very attractive. No investment will give you so much return. But then when greed overpowers you, you will put everything at stake for that. And that fellow gives you also 36% interest in the first year. So that you will bring more money. You will also bring your friend and relative. See, I have one. Then friend thinks this fellow has become so rich. And I am here just in interest, earning 6% interest. He will also go. That person who is borrowing, after 2 years, again he will pay. Again more confidence. Now you will sell everything and invest in that property, invest in that scheme. Third year, when you go to meet him to recover your interest, he is not there. Okay, his office is locked. He is nowhere inside. And then you just keep searching. That is what some people design these schemes. Okay, don't look at me. I don't do like this. Now, next point. Next few points are in general the money market discussion. So this you write for all the bullet points, general discussion. The institute have given it under the heading unorganized money market, but these are general observations about money market. The size of the unorganized money market is difficult to estimate, though it appears to be fairly large. Of course, you can't estimate the unorganized sector. How do you estimate? Because there is no record only. But it is very large in India. Its importance relative to that of the organized money market is declining. So as a student of commerce, accounts, finance, this point is important. In the last many decades, government has taken steps to ensure that organized finance reaches the poorest of the poor people. Okay? So they have launched microfinance schemes. They have Grameen banks. Okay. Then regional RRB, regional rural banks, NABARD, SIDB. Why all this? Small Industrial Development Bank of India, priority sector lending. These schemes have ensured that even the farmers, agriculturists, artisans, poor, they have some organized source of finance. So as the role of organized money market will increase, the role of unorganized money market will decrease. Okay. Statistics have also shown that role of unorganized money market is declining in India. But India is a big country. Still, the size is very high. Written whatever you wanted to write. Why the role of unorganized sector is decreasing, you have understood. And connected to that point is this point. This is a welcome development from the point of view of RBI, because RBI will be happy to hear this news that role of unorganized sector is declining because of the existence of a large unorganized market frustrate its efforts to control the credit. If there is a large unorganized sector, remember, whatever policy RBI will devise will be a failure. Maybe if you are attentive in some earlier lecture, I have said CRR, SLR does not work in India. That statement I had given. There is an unofficial statement. Why it doesn't work in India? There is a huge unorganized sector. You said if I increase CRR, people will stop borrowing, or the amount of money available for borrowing will reduce. But there is a parallel economy. Is it right? If a builder constructs a building of 20 crore rupees, he will say how much is through white channel and how much is through black channel. 50-50. He is saying 50-50. I don't know, but maybe you are right. Now, if the RBI decreases or increases CRR, will you affect that sector? Negligible effect because of unorganized money market. And that is why RBI will be happy to hear this news that the role of unorganized sector is declining. Only then the monetary policy can be implemented. Access to call market was restricted to scheduled commercial bank. Now they are giving some general discussion, which actually they should have written in some other heading. Anyway, quickly we'll discuss them. Access to call money market. Call money market means market for very short term. Market for very short term, maybe 1 day to 14 days, was restricted to scheduled commercial bank. Earlier policy of RBI was that only scheduled commercial bank will participate in call money market till 1971. Then RBI permitted UTI and LIC to deploy their short-term funds. Now even LIC and UTI were allowed to invest in call money market. That means they can also lend to the bank for short term. They can also do this. LIC, as you know, is sitting on huge amount of funds in terms of 10 lakhs of crores of rupees are there with them. How much? Not 1 lakh crore. More than 10 lakh crore is the surplus they have now, because they have collected premium from crores of people for last so many years and without paying them much of the settlement amount. Some amount they have settled. Yes or no? But amount they earn and the amount they pay, my calculation have suggested they earn a huge amount compared to what they pay, right? So where will they park their surplus? So now LIC can park in this interbank call money market. Even UTI, which was the monopoly in the mutual fund industry till 1984, from 1964 to 1984, only one mutual fund was there, and they used to earn huge amount of money. So they were also allowed to participate in call money market. And later on, this list was expanded to include cooperative bank and other term lending financial institutions like IDBI, IFCI, ICICI. All these, you know. S means State Credit Investment Corporation of India. S means state, and Credit and Investment Corporation. State also have some financial institutions. Okay, every state. So they could also participate in call money market. Mutual funds lost by the public sector banks were also allowed, and investment institutions and mutual funds settlement in private sector. So now more and more people are allowed in call money market, okay, which was earlier only restricted to scheduled banks. And then to make money market more vibrant, more efficient, RBI allowed the money market mutual fund. MMMF means money market mutual fund set up in the public and private sector to participate in the money market. So special mutual fund was created, a special scheme which will only invest in money market instrument. Former finance minister agreed in principle to allow the Department of Post to invest its short-term funds in the call money market. So even now they are planning that Department of Post, which also have got huge surplus, okay. These all old time government institutions are sitting on huge pile of money. You also invest. So more and more people will enter money market, the role of unorganized sector will reduce. That is the idea. While banks and UTI can lend as well as borrow, underline, banks and UTI can perform both functions, borrow and lend. Financial institution, General Insurance Corporation, LIC, mutual fund, MMMS can only lend in the call money market. They can only lend but not borrow. The private sector banks and mutual funds have been demanding a level playing field vis-a-vis UTI. So they are saying, why UTI is given preference? UTI can borrow also, lend also. But we can only lend, we can't borrow. Regarding the facility to borrow from the money market so as to meet their redemption requirement. Because if you can borrow, it makes management of liquidity easier, better, okay. If suddenly there is a redemption requirement of bonds, debentures, preference share, you can borrow, redeem, okay. This facility comes in handy for them, particularly in a declining market, as they can obtain the required short-term funds at a lower cost. So that is why the private sector entities are demanding we should also be allowed to borrow in term money market. Term money market rates may be lower also, so from cost point of view. This is because of the large difference between the cost of the short-term funds in the organized money market and that in the unorganized or informal or money market. So why do more and more people want to borrow from organized market? Interest rate is low. Unorganized market interest rate is high. It's almost 2 times or 3 times in the unorganized market. And of course, if you are an entity, a businessman, you would try to minimize your cost. But if you can't get money from organized market, businessmen go to other extreme also. They will go to unorganized sector to raise the funds. They need money. Business should run. The participation of LIC, GIC, UTI would increase the availability of short-term funds and enable UTI to meet any large repurchases from unit holder also. UTI has a right to borrow also. So if some big unit holder, let us say Reliance is a unit holder of Unit Trust of India, and they put a redemption request of 500 crore rupees on a given day. UTI will not have a cash balance of 500 crore in their account. So they can borrow from call money market and they can redeem. But other mutual funds are not allowed. Now rules have been simplified in the last so many years. Mutual funds have now been permitted to borrow from money market to meet their dividend, interest and redemption obligations. So after a lot of pressure, other mutual funds are allowed, but there is a limitation. They can borrow only up to 20% of their net asset owned. After a lot of research or a lot of debate, discussion, other mutual fund can borrow up to 20%, but only for this purpose: dividend payment, if they have a dividend obligation, interest obligation or redemption obligation. MMF provide an ideal vehicle for an average investor. Now suppose you are a student, okay? You are not average investor, just for example. So you have your stipend of 1 year saved 48,000 rupees. Now you want to invest in a money market instrument. Today you got inspired and you want to invest in commercial paper, certificate of deposit, treasury bills. But you can't do that because there is a minimum ticket size. Ticket size means minimum lot you have to buy, which may be 1 lakh, 5 lakh, 25 lakh according to company. And according to bank, they will put this kind of limit. Okay. You can't do that. Don't cry. Invest in MMF. And they will invest in commercial paper, certificate of deposit, treasury bill, etc. Because then lakhs of articles will invest. Lakhs of investors will invest. So they have a huge cash surplus and then that can be invested. Okay. Which to reap the benefits of high call money rates and high yield on money market instrument, which hitherto have been enjoyed only by banks and financial institutions while paying a lower rate of interest on deposit. Banks are very smart, but they are businessmen also. Businessman has to be smart. They give very low rate of interest to depositors and they earn a very high rate of interest on the lending. Call rates are very high sometimes, I have told you. So from you they have borrowed at 6 to 7%, 8%, and to the other bank they lend at 20%, 25%, sometimes 40% also. Now you are an investor. You can also enjoy that benefit of high interest rate. Instead of investing in bank FD, you can invest in a money market mutual fund so that you will also enjoy the high rate of interest at times. So that is why MMF was started, so that even people can participate indirectly in the money market instrument. And it gives you high return, it gives you liquidity. Every benefit of mutual fund is available in money market mutual fund scheme. Now we'll come to an overall view of structure of Indian money market. This is what we discussed briefly. Some more points may be pending. In the coming time we will discuss. So structure of Indian money market, broadly 2 types, organized and unorganized. Unorganized consists of indigenous bankers, money lenders, chit fund, nidis. In some state they are called chit fund, in some state they are called nidis. Don't go into too much of detail right now. We want to eliminate unorganized sector. Okay. Don't learn this trick also. Learn organized sector. Learn RBI, commercial bank, post office, saving bank, PO savings, post office, NBFC, cooperative banks. These are organized because they came under some or the other regulatory jurisdiction. Commercial banks may be scheduled, non-scheduled bank. Scheduled banks are public sector, private sector. Public sector means state bank and its associates and nationalized banks. Non-scheduled bank can be foreign banks or regional rural banks. Scheduled banks come under the schedule of RBI. Which are scheduled banks? Which come under the schedule of RBI. So RBI has a schedule, and those banks whose names come under that schedule is scheduled commercial bank. Now we'll come to money market participants, that is institutions, in detail. Some of them have been covered in previous chapter, so probably they will not be discussed in detail now. Like for example, RBI. Have you covered RBI in detail in some earlier chapter? Yes, sure. Okay. RBI. We have discussed their monetary policy, their instruments, okay, some regulations. RBI is the boss in money market. It is the most important participant of money market, and RBI through money market is able to implement the monetary policy also. That is, they can increase the interest rate, decrease the interest rate, they can sell government securities, buy government securities, and therefore they are able to implement monetary policy also through money market instrument. RBI regulates the money market in India. So this can be a true-false question. SEBI regulates the money market instruments. False. RBI regulates the capital market. Again false. RBI also injects liquidity in the banking system when it is deficient or contracts the same in the opposite situation. How? One is through rate of interest, one is through open market operations, SLR, CRR. So that is what RBI does. RBI has been covered in detail in other chapters also. Next is scheduled commercial bank. Who is the next most important player in this money market? Commercial banks. They are the nucleus of money market because they have to maintain SLR. Remember, 20% of their demand and time deposit they have to maintain in SLR, and SLR is nothing more or less government securities. Okay, and plus they are a big time borrower and lender in the interbank term money market also. So they are issuing certificate of deposits also. So they are the most important borrowers and supplier of short-term funds. They mobilize the saving of the people through acceptance of deposit, lends it to business houses for their short-term working capital requirement. Bank OD, CC, working capital loan, these are all short-term loans. While a portion of this deposit is invested in medium and long-term government securities and corporate shares and bonds, they provide short-term funds to the government by investing in treasury bills. So they are a big time investor of treasury bills. In fact, they are forced also by government, okay, because they have to maintain SLR. Next is cooperative banks. Good news. Function similar as commercial bank. Financial and investment institutions. These institutions like LIC, GIC, UTI, development banks have been allowed to participate in the call market as lenders only. But again, some of them are allowed as borrowers also, like UTI. Tick mark there. UTI can borrow also. underline you or write down. UPI can borrow also. Next important participant in money market is corporates. They are also big time player for both reasons. They need funds, they have surplus. Some corporates have lot of money, so they need place where they can park their short term surplus. Some corporates are having deficiency, so they need to borrow for short term. Okay, so they create demand also, they create supply also. They create demand for funds from the banking system, they raise short term funds directly from the money market by issuing commercial paper. So commercial paper instrument we'll discuss in detail in the next segment, money market instrument, but it is a short term unsecured instrument issued by corporate. Don't write also, it will come as a full heading. They accept public deposit under the Companies Act. Have you heard that public deposit under Companies Act? Unsecured loan, usually for 3 years. And they have to comply with a long list of acceptance of deposit rules. Okay. So that can be for short term also. That can be for short term also. They also borrow in inter-corporate deposit and investment market, ICD market. ICD market means borrowing and lending between corporates. One corporate to other corporate. Generally they know each other. Generally it is in group companies. Okay, but not necessarily. And they earn a high rate of interest on their surplus. So that also we will discuss. This inter-corporate deposit there is a separate segment in your next heading, money market instrument. So this is the role of corporates in the money market. Now is mutual fund. They invest their surplus fund in money market instrument for short period. Again, they are big players. And they are also permitted now to participate in call money market. Earlier as a lender only, and now as a borrower for meeting their interest, dividend and redemption requirement, subject to not more than 20% of net funds owned. MMF, now there is a specially created MMF whose main role is to invest in money market instrument. And the next is one last one, Discount and Finance House of India. This is again a specially created organization, an entity for promoting money market transactions. So what is the role of this DFHI? Discounting, as the name suggests, has been set up by RBI jointly with other public sector banks and all India financial institution to deal in short-term money market instrument. Started operations in April 1988. At present, DFHI participates in interbank call money or interbank notice money market and term deposit market, both as a lender and a borrower. So this has been given this power to participate in interbank call notice money market, both as a lender and borrower. And the purpose why it was started was to rediscount the bills. So those who need funds, they can get their government bills discounted with DFHI. Suppose you have government bill, commercial paper, certificate of deposit, you need money. Go there. Just like your bill discounting you have learnt in accounts classes. So they will discount it and hand over the balance funds to you. So this will bring liquidity in the market. That is their function. It rediscounts 182-day treasury bills, commercial bill, certificate of deposit and commercial papers. Okay. So these are the main players in the money market. Now tomorrow we'll discuss in detail each money market instrument. Okay, and then tomorrow we'll solve few questions also to keep you awake. We will solve few questions also. Right. Now we'll continue tomorrow.